Hey everyone, welcome back. Ready for another deep dive?
Definitely.
So it's this English learning podcast called Daily Money Briefing.
Huh. Interesting. Okay.
It's actually pretty cool. You get the
Yeah.
financial news and kind of a language lesson all in one.
Oh, I like that. Sort of killing two birds with one stone.
Exactly. Today we're looking at a few different threads from the global economy.
Right. We've got rising mortgage stress in South Korea, some big changes to their deposit insurance.
And yeah, how U.S. markets just kind of shrugged off a credit outlook downgrade.
Exactly. Three things that seem separate, but maybe aren't.
Our mission today is to sort of pull on these threads, see how they connect, and, figure out what it might signal for the bigger picture. Maybe even for your own finances.
Yeah, what strikes me immediately is that contrast. You've got real people under pressure in Korea, and then this very macro, almost indifferent reaction in the U.S. Let's start with those Korean mortgages.
Okay, so there's this term young cool. It basically means people went all in, right? Leveraged everything to buy property during the boom.
Precisely. Borrowing to the absolute max, and now, well, the market's cooled off, rates are higher.
And people are feeling the pinch.
Definitely. We saw figures from KAMCO, the Korea Asset Management Corporation, overdue mortgage restructurings. They jumped 140% last year.
Wow, 140%.
Yeah, hit 20.5 billion won. That's up from just 8.5 billion the year before. And the number of actual cases more than doubled.
So a big increase.
Huge. It's the highest volume they've handled since 2020. It really shows the strain from that housing boom slowdown and, of course, the higher interest rates biting.
It reversed a couple of years of decline in those cases too, right?
It did. A clear sign of mounting pressure on households.
Okay, so while individuals are navigating this tricky situation with their mortgages, the South Korean government's making a pretty big strategic move.
That's right. With their deposit insurance fund.
Can you quickly remind us what that fund actually does?
Sure. It's basically the safety net. If your bank goes under, this fund guarantees your deposits are safe, up to a certain limit, protects depositors.
Got it. And they're changing how it's managed.
For the first time in 30 years, yeah. It's an 18.5 trillion won fund, and they're planning to diversify. The big news is allocating 10%, that's about 1.85 trillion won, or 1.4 billion US into dollar assets by 2027.
Dollars, so U.S. assets.
Primarily. They actually just bought $500 million in US Treasuries as part of this.
Interesting. Why the shift? Why now?
Well, it seems like a two-part strategy. One, it helps protect the fund's value against, swings in the currency markets, hedging risk.
Makes sense.
And two, they're moving away from just keeping the money in bank deposits towards more active bond investments. Suggests they're looking for, well, better returns and maybe just more overall stability for the fund.
So individual stress meeting government strategy in Korea. Okay, let's hop across the Pacific now. The U.S.
Right. Moody's?
Moody's lowered the outlook on the U.S. credit rating to negative. For people not totally immersed in this, what does a negative outlook actually signal? Is it bad?
Think of it like storm clouds gathering. It doesn't mean it's raining now, but the forecaster, Moody's in this case, sees a higher risk of a downgrade down the line. It's a warning sign.
Okay, warning sign. Usually you'd expect markets to react to that, maybe get a bit nervous.
Typically, yeah. You might see stocks dip, maybe bond yields shift more dramatically.
But that's not really what happened, was it? The Dow, S&P, NASDAQ, they all ended slightly up that day.
Pretty much flat, yeah. Maybe a tiny initial wobble in Treasury yields, but they settled quickly. It was surprisingly calm.
So why the quiet reaction? Did the markets just not care?
Well, the general take from analysts was, this isn't exactly new news. The U.S. debt situation, the political polarization affecting fiscal policy, it's been discussed for ages.
Ah, so Moody's was just stating the obvious, in a way.
Kind of. It wasn't a shock announcement. The market seems to have already baked that possibility into prices. Maybe they're more focused on inflation numbers or the Fed right now.
Right. It suggests maybe what usually moves markets is changing a bit.
Could be. Or just that this particular piece of news wasn't, well, news.
Okay, let's pull these threads together then. We've got South Koreans struggling with mortgage debt.
That very real individual-level financial stress.
Their government making a strategic long-term move to secure its finances.
Diversifying the deposit fund, hedging risks, a proactive step.
And then the U.S. markets barely blinking at a negative credit outlook signal. What's the connecting insight here?
Well, I think it really highlights this potential disconnect. You have significant financial pain for individuals in one major economy,
Yeah.
while global markets seem almost indifferent to traditional warning signs in another, arguably the most important, economy. The struggles in Korea point to vulnerabilities that maybe get lost in big aggregate numbers.
And the U.S. reaction.
It forces us to ask, what really drives market sentiment these days? When do these established indicators, like a credit outlook, actually matter, and when do they not?
So, wrapping up, we saw the pinch from young, cool financing in South Korea, the government's pivot with its insurance fund, and the U.S. market's quiet response to Moody's outlook change.
Right. And maybe the final thought for you, the listener, is this. Given how interconnected everything is financially, how might these specific pressures in Korea eventually ripple outwards, maybe in ways we don't expect?
And what does it mean when markets seem to ignore what we traditionally think of as bad news? Does it mean our assumptions about economic stability or what signals danger need another look?
Exactly. Something to keep an eye on. Thanks for diving deep with us today.